Imagine if you had invested £100 into the stock market 10 years ago. Today that could be worth more than double. The truth is, investing isn't just for the Wall Street bankers or the super wealthy. It's something anyone can start, even with small amounts of money. In this video, I'm going to walk you through a simple beginner's guide on investing step by step. Hi everyone, welcome back to my channel. My name is Manu and I come from a cybersecurity background in financial services. I started this channel to make finance less intimidating and to help beginners like you take your very first step into the world of investing with confidence. First, let's talk about why investing matters. Most people rely only on savings, but here is the problem. Savings account barely keep up with the inflation. That means your money is actually losing its value over time. Investing, on the other hand, is actually allowing your money to grow and work for you. Whether your goal is to retire early, buy a new home, or just have more financial freedom, investing is the tool that will get you there. And you don't need thousands to start with, thanks to modern apps and platforms that help you start from as little as £10 or $10. Now, let's break down the basics of investing. When you hear investing, you may have heard of the terms stocks, bonds, ETFs, funds. Let's break down what they are. Let's start with stocks or shares. Think of stocks as owning a slice of a company. So if you purchase a stock in Apple, you become part owner in the company. If Apple grows, your share becomes more valuable. Some companies also pay dividends. It's just a small percentage they pay out just for holding the shares in that company. If you invested £1,000 into Apple 10 years ago, that investment would be worth over £12,000 today. Now let's talk about bonds. Imagine lending money to your government or a company and they pay you interest for lending that money. That's technically what bonds are. Bonds are usually less risky than stocks, but they also give smaller returns. Think of them as a steady and safe part of the portfolio. As an example, a UK government bond might pay 3% per year, which means if you invest £1,000 into the bond, you will get £30 per year in interest. Now let's talk about funds. There are different types of funds. There are mutual funds, index funds, ETFs. But they are essentially all doing the same purpose. With funds, instead of picking one single company, you're investing into hundreds of different companies in one go. An index fund is a ready-made basket of companies. So this would include things like S&P 500. That's a great example of an index fund. So S&P 500 tracks 500 of the biggest companies in the US. This would include companies like Microsoft, Amazon, Apple, etc. An index fund and an ETF are very similar, except an ETF is traded more like a stock, which means you can trade it throughout the day. The benefit of using an index fund or an ETF is diversification. By diversifying, you are reducing your risk. This means your risk is spread out. If one of the organizations in your pool struggles, the rest of the companies balance it out. Over the last 30 years, S&P 500 has returned on average 10% return per year. That means if you invested £100 every single month into S&P 500 for the next 20 years, you could have around £70,000 in your account, although you have only put in 24,000 of your own money. That's the power of compounding. So how do you actually begin your investing journey? Here is a clear step-by-step roadmap. Step 1 is to choose a platform. In the UK, there are beginner-friendly platforms which include Trading 212, Vanguard or Free Trade. In the US, you could try Fidelity, Vanguard or Robinhood. All of these apps let you start investing from as little as £1 or $1. Step 2 is to pick the right account. In the UK, there are things like Stocks and Shares ISA. In the UK, a Stocks and Shares ISA lets your investment grow tax-free. In the US, a 401k or Roth IRA can give you tax advantages with investments. If you are just testing the water, any simple brokerage account works fine too. Step 3. Start small and be consistent. You don't need thousands to begin investing. Even investing £25 a month builds the habit, but consistency is the key. This is where the dollar cost averaging comes in. No matter what the market is doing, your investments are consistent. Let's look at an example. If you invested £100 per month for the next 30 years and the market averaged 8% returns per year, you would end up with £140,000 although you only contributed £36,000 yourself. Okay, let's choose your first investment now. Instead of gambling on one hot stock, let's start with a broad index fund or an ETF. This is the most beginner-friendly way of purchasing multiple or hundreds of stocks in one go. It's less riskier and gives you a reasonable return at the same time. We can start with something like S&P 500. There are different variations available of this, but one from Vanguard is pretty standard. But that doesn't just limit you from purchasing it from the Vanguard platform itself. You can purchase the Vanguard's version of S&P 500, which is called VUSA, V-U-S-A, which can be purchased from either free trade or trading 212, and of course Vanguard's own platform. An example of investing in S&P 500 looks something like this. If you invested £1,000 into an S&P 500 ETF about 20 years back, you would have something like £6,000 today. One of the most important thing or the tool that you have at your disposal is time. Let time do its work. Compounding is your best friend here. The earlier you start, the more compounding growth you will get. Let's look at an example. Someone who started with £200 per month investment at the age of 25 would have about $500,000 or more than $500,000 by the age of 60. Let's say they waited until 35 to start investing. With the same £200 per month, they will have about £240,000 by the age of 60. That's less than half of what they would have if they started 10 years before. That's the true power of compounding growth. Now let's talk about what not to do when you're investing in stocks. Do not chase hot stock tips from social media or anywhere else. Do not try to time the market. You will never get it right because even professionals get it wrong all the time. Don't put all your money into one company. Doesn't matter how strongly you feel about the company or how much information you have on it, it's still too risky. The key here is patience and consistency. Always maintain that consistency of paying in every single month. I know as a beginner, when you come into stock market investing, you are expecting higher returns. People are expecting 30%, 40%, or even 50%. When you hear investment returns of 8% or 10%, it might seem very low, but this is where the true investing happens. You can't keep that consistency up. You will make some money today, you will lose some tomorrow. That's not investing, that's called trading. So we are not trading here. We are not gambling with our money. We want a constant, consistent growth of our portfolio with compounding. And we are diversifying our portfolio with index funds or ETFs, meaning our money is distributed in a huge pot of hundreds, if not thousands of companies. So here is the takeaway. You don't need to be rich, you don't need to be a financial guru, and you don't need to overcomplicate it. Investing is simply putting your money to work over time. So start today. Even if it's just £20, your future self will thank you. If you found this video helpful, hit that like and subscribe for more beginner-friendly tips. And let me know in the comments if there is something holding you back from starting your investment journey. Thanks for watching the video, and I will see you on the next one.